because we're going to react, not predict. So you work the thesis. You say, if this happens, I'm going to do this. You wait for that thing to happen and then do it. Macro works very well because it gives you an unhindered view. So right now, for instance, debt yields are high and coming down. I think even today the yields are much lower than they used to be even 3 weeks ago. The rupee is also, it had gone to 83, now it's 81.5. So why is this macro important? Why is this important for me to understand this in general? Is that it gives me a framework to understand what players are thinking and looking at. If interest rates are too high in the US, won't it affect how much inflows come to India? If it does affect those inflows that come to India, then how much will that impact our stock markets in general? This is was unpredictable right now to say how much domestic investors actually added to their portfolios so much money that it outstripped how much ever FIIs were taking out of India. This is the first time it's ever happened like that. Not predictable, but what you could predict is, we will see an exodus of funds. We thought about this last year and said, okay, there was roughly 150, 200,000 crores that came in during COVID, and that part of it will go out. But whatever came in during COVID, that much you could say. But how might that impact the stock market could not be predicted. So at best, it gives you a framework to think and sometimes opportunities as well. So when interest rates were very low, a certain set of businesses made a lot of sense, especially in the West. People copied those businesses in India and put their names to it. No, whether it was offline or online doesn't matter, but they were copycats who built their businesses here. When interest rates go up in the US, some of those businesses are valued at much lower than 2 or 3 years ago. But the Indian counterparts are valued at the same as 2 years ago. And since those valuations haven't come down, so to that extent, there will always be something or the other that changes worldwide and eventually affects India. But you get an idea of saying, okay, this is exactly what's happening. For instance, right now we're predicting and that home sales in the US will come down. Now, it doesn't make any difference to our investing strategy today. But I do know that if home sales come down, that means there's a recessionary tendency in the US. That recessionary tendency means that there will be people buying less stuff if their house prices are low and they may have lost their jobs or whatever. There could be foreclosures in the US. This affects the BFSI industry. If all of those things are going to happen, then we're going to see that the stock prices of some of these stocks will come down. The business updates of some of these companies will show that there's a negative impact on their revenues or higher impact on their expenditures and so on. That will translate to their suppliers, say in India or in any other part of the world, getting affected, because if you have to fire 50 people or 100 people, you're also firing some of the people that you outsource this work to. So that part of the business is an interesting point, because then you're saying, I'm going to work with what if scenarios. What if this happens and this happens? Then I need to make sure that I'm out. So for instance, if I think that my stocks, and we have a stock which makes tires that are sold in Europe. So to me, a European recession is a risk, is a key risk. But I am saying it's a risk. Doesn't mean that I know it will happen or where it will be bad for my company. It could be that the European manufacturers, who are the competitors, shut down. In which case, this guy who's from India suddenly gets lots of business. So I don't know the answer to what will happen. All I know is something will happen, and let me just figure out, based on a lot of these factors, which of these two scenarios is happening. Is the Indian company losing business, or are the competitors inside Europe going out of business, and therefore gives me an opportunity to continue this. So for this, I have to look at the European macro to understand where things stand and how their governments will respond, because government response is also interesting and important to how markets perform. To me, macro level investing gives me a greater framework to build an investment thesis. And today we formed an investment thesis around India, which is almost entirely, starting from the macro. And 2 years ago, I actually talked about this, and we had a podcast about it. I said, if the US was planning to print $5 trillion after COVID, I said, in this $5 trillion, because it makes its way around the banking system and eventually to hedge funds and investment funds, 1% of this money will come to India. 1% of such money always comes to India worldwide. 1% of $5 trillion is $50 billion. $50 billion is 3,75,000 crores. That time rupee was 75 to a dollar. So for 3,75,000 crores. In 3 months, 2 lakh crores came just to Reliance. And then India got another 2 lakh crores over the course of the next year. So we got 4 lakh crores, which is almost exactly the amount that I said will happen. But I could not predict it will come to Reliance. I could not predict that it will come to how much will come to the market, when it would come. All I knew that if you print so much money, some part of it will make its way to India. That's how the macro has. So we took a long bet at that time. We said, let's go to large caps because that's where the volumes are going to be. So we switched our investment strategy based on this macro assertion that this is going to happen. But we said we'll do it over time because as we see this money coming in, that is when we want to move more money in because we're going to react, not predict. So you work the thesis. You say, if this happens, I'm going to do this. You wait for that thing to happen and then do it.
Very, very, very interesting. So